There is a market worth roughly $600 trillion that most people have never heard of, and even fewer truly understand. This market quietly sits beneath the global financial system like a fault line, invisible until it shifts. And when it shifts, it breaks everything above it. It almost destroyed the global economy in 2008, and instead of being reduced, it has since grown to more than 10 times its previous size. Warren Buffett warned in 2003 that derivatives were financial weapons of mass destruction, and he was not exaggerating. They triggered the collapse of Lehman Brothers, the bailout of AIG, and nearly toppled the entire global banking system. The response to that crisis was not to dismantle derivatives, regulate them aggressively, or reduce their scale. Instead, the world doubled down. Banks expanded derivative trading, governments allowed it, and investors relied on it even more. Today, the notional value of the derivatives market exceeds 6 times the size of the entire global economy. If it detonates again, there simply will not be enough money anywhere to bail it out. And yet most ordinary people have no idea these instruments exist. Even professional investors often struggle to explain them beyond vague analogies and textbook definitions. Derivatives underpin almost every major financial system on Earth. They are woven into the operations of global banks, pension funds, insurance companies, and government bond markets. In theory, derivatives are designed to reduce risk by allowing institutions to hedge against volatility. In practice, they amplify danger by stacking layer upon layer of leveraged bets. Leverage built on leverage, built on more leverage until the entire system becomes a tower of dry timber waiting for a spark. What begins as a hedge often turns into a speculation, and those speculations multiply across institutions until the total exposure becomes unknowable. That uncertainty is exactly what causes panic when the system comes under stress. In 2008, preventing total collapse required over $29 trillion in combined bailouts, guarantees, and emergency liquidity injections. And that was when the derivative market was only around $60 trillion. Today it is 10 times larger. If the previous version nearly ended the modern financial system, the next explosion will be global, immediate, and irreversible. It won't look like 2008. It will be far worse. To understand why derivatives are so dangerous, you have to understand what they actually are. A derivative is simply a financial contract whose value is derived from another asset. That definition sounds harmless, but the underlying asset can be anything: a stock, a bond, a commodity, an interest rate, a currency, even the probability of an event occurring. And critically, you do not need it to own the underlying asset to place the bet. It is like buying insurance on your neighbor's house and collecting money if it burns down. The incentive structure becomes distorted from the very beginning. Futures, options, swaps, and forwards are the most common forms. A futures contract lets you speculate on the price of oil or wheat. An option gives you the right to buy or sell an asset at a set price. Swaps exchange cash flows, like trading fixed interest payments for floating ones. Forwards are custom agreements to buy or sell in the future. Each of these can serve a legitimate purpose. Farmers really do use futures to lock in crop prices. Airlines genuinely hedge fuel costs. Corporations hedge currency risk across multiple countries. But farmers are not the ones dominating the derivative market. Global banks are, and they use derivatives to construct massive leveraged positions bets that can be hundreds of times larger than the capital backing them. A $100 million swap might require just $1 million in collateral, creating 100-to-1 leverage. When markets move slightly against the bet, the collateral is wiped out. When they move further, the bank owes money it does not have. Now scale that across tens of thousands of contracts held by dozens of interconnected institutions, and you begin to see why a tiny market movement can trigger a chain reaction of failures. The deeper threat comes from complexity. Modern derivatives have become so intricate that even the engineers who build them cannot fully predict how they behave during stress. Credit default swaps, one of the main culprits in the 2008 meltdown, were intended to insure against corporate or mortgage defaults. Instead, they became speculative gambling tickets. Investors who never owned a single mortgage could bet on a mortgage market collapse. AIG, the insurance giant, sold hundreds of billions of dollars of these swaps while setting aside almost nothing to cover potential losses. When housing crashed, AIG suddenly owed more money than it had in total assets. The only thing preventing a financial extinction-level event was a $180 billion emergency intervention by the government. But the most frightening feature of derivatives is a counterparty risk, the invisible chain of obligations that links every institution together. If one bank fails to pay what it owes in a derivative contract, the bank expecting the payment suddenly takes a loss. That loss weakens it and may cause it to default on its own obligations. Failures cascade like a row of dominoes. The collapse of Lehman Brothers is the clearest example. Lehman had over $30 trillion in derivative exposure. When it went bankrupt, every institution connected to it, directly or indirectly, suffered instant losses. Banks stopped trusting one another. Credit markets froze, and panic rippled through the global economy. The logical response after 2008 should have been obvious. Restrict or ban the most dangerous forms of derivatives, especially speculative instruments like naked credit default swaps. Instead, regulators introduced modest reporting rules and moved part of the market into clearinghouses. The core of the system, however, was untouched. Banks defended derivatives as essential tools that provided liquidity and reduced risk. Regulators accepted the argument, or were pressured by the staggering influence of financial institutions. The result is that the derivatives market did not shrink. It ballooned from $60 trillion to over $600 trillion. The scale now exceeds anything seen in modern economic history. And understanding what happened in 2008, when the market was a fraction of its current size, reveals just how vulnerable the world is today. The 2008 crisis began with subprime mortgages loans, given to borrowers who could not afford them. Those mortgages were bundled into securities and sold as safe investments. But derivatives turned this localized bubble into a global catastrophe. Banks created layers of synthetic products tied to the mortgage market. Profits skyrocketed on the way up. But when the housing market faltered, losses multiplied with equal ferocity. Lehman Brothers appeared solvent on paper, with $6 billion in assets and $60 billion in liabilities. But those numbers hid the real danger: more than $35 trillion in derivative exposure. When housing prices fell and derivative values collapsed, counterparties demanded more collateral. Lehman could not provide it. By the time the bank failed, no one would trade with it. Its collapse instantly triggered losses across hundreds of institutions. A bank in Europe holding protection from Lehman suddenly had no hedge. A pension fund expecting interest payments from Lehman received nothing. The system was so entangled that one institution's failure rippled outward through the entire global network. That was the warning shot, and the world ignored it. Some institutions did fail in 2008, while others barely survived by cutting exposure to anyone they did not completely trust. Credit markets froze because banks would not lend to one another, and liquidity evaporated from the global financial system almost overnight. But if Lehman's collapse exposed how interconnected the system had become, AIG's collapse revealed something even darker: how one single category of derivative credit default swaps could vaporize $1 trillion company and threaten to drag everything else down with it. AIG's financial products division sold roughly $500 billion in credit default swaps to banks and investors, effectively insuring them against losses on mortgage-backed securities. For years, AIG collected premiums and believed the risk was minimal. Why? Because housing prices had never fallen nationwide in modern American history. The assumption was not just flawed, it was delusional. When housing finally did fall, AIG owed tens of billions of dollars in payments it simply did not have. The company's credit rating was downgraded, which automatically triggered clauses in its derivative contracts, requiring AIG to post even more collateral immediately. The entire structure collapsed in a matter of weeks. The Federal Reserve intervened with an $80 billion emergency loan, but this barely covered the initial bleeding. By March 2009, government support to AIG had ballooned to roughly $180 billion, the largest bailout in American history. But the bailout was not truly for AIG. It was, in reality, a covert rescue package for the large banks that had bought credit default swaps from AIG and would have suffered catastrophic losses had AIG defaulted. Goldman Sachs alone received nearly $13 billion. Merrill Lynch received almost $7 billion. Bank of America, Deutsche Bank, and numerous others received billions more. The government funneled taxpayer money through AIG to quietly compensate these institutions, revealing a brutal truth about derivatives. When the bets fail, the system refuses to allow the consequences to fall on the institutions that made them. Instead, losses are transferred directly to taxpayers. Saving the financial system in 2008 required staggering amounts of public money. The government committed $700 billion through the TARP program. The Federal Reserve injected more than $4 trillion through quantitative easing and emergency lending programs. Governments and central banks around the world contributed another $25 trillion in loans, guarantees, and capital injections. Combined, the total global commitment reached approximately $2 trillion, nearly twice the size of the entire economy at the time. And all of this was to stop a collapse of a derivatives market that was only $60 trillion in notional value. The system survived, but barely. And the critical lesson should have been unmistakable. Derivatives had grown too large, too opaque, and too complex for anyone to fully understand or control. But instead of shrinking, the market accelerated. The Dodd-Frank Act of 2010 introduced reforms aimed at improving transparency. Standardized derivatives had to pass through central clearinghouses, theoretically reducing counterparty risk by allowing a single institution to guarantee both sides of a trade. Reporting requirements increased, so regulators could at least see the size of the exposures. But the law never addressed the fundamental problem: the scale. It did not ban the derivatives most responsible for the crisis. It did not meaningfully restrict leverage. It allowed banks to continue making enormous speculative bets using depositor money, backed by the implicit guarantee that taxpayers would rescue them again if things collapsed. Within a few years, lobbying pressure softened many of the reforms that had been passed, and the derivative market resumed exponential growth. By 2010, it surpassed $600 trillion. Today, in late 2005, the market still sits above $600 trillion notional value. Global GDP is roughly $100 trillion. That means the derivatives market is 6 times the size of all global economic activity combined. If even 5% of those derivatives fail, the losses amount to $30 trillion, 3 times the global bailout cost of 2008. There is no central bank, no international coalition, no financial mechanism capable of absorbing such losses. The system simply was not built to withstand that scale of failure. The composition of the derivatives market makes the situation even more dangerous. The largest category, by far, is interest rate derivatives, which account for more than $5 trillion of the total. These are bets tied to the direction and volatility of interest rates. Banks claim they use them for hedging, but in reality, they also use them aggressively to speculate. As long as rates remain stable, these contracts appear safe. But in the last 3 years, interest rates have moved faster than at any time in the modern era. The Federal Reserve raised rates from near zero in 2021 to above 5% by Q3, the fastest jump in 40 years. Every rate increase created winners and losers. The winners booked profits. The losers accumulated losses quietly, burying them inside balance sheets, using accounting rules that allowed them to avoid marking the positions to market. Those losses still exist. They simply are not recognized yet. Banks continue pretending their derivative books are balanced, but the reality is that many are sitting on massive unrealized losses triggered by the most violent rate cycle in a generation. Credit derivatives, around $50 trillion in notional value, represent the second largest category. Credit default swaps remain the primary instrument in this space. Regulators vowed after 2008 to clean up this market. They did not. Banks and hedge funds still use CDs to bet on corporate and sovereign defaults. But the environment today is far more dangerous. Corporate debt in the United States has exploded from about $2 trillion in 2008 to more than $10 trillion by 2020. Much of this debt was issued at near zero interest rates. As companies refinance at significantly higher rates, many will face insolvency. When those defaults occur, the credit default swaps written on that debt will be triggered. If enough defaults accumulate simultaneously, the sellers of credit protection will be hit with losses they cannot absorb. It is age all over again. Except this time, the Federal Reserve may not be willing or able to print another $180 billion to rescue the losers. Currency derivatives add another $100 trillion to the total. These instruments become extremely volatile when exchange rates move sharply. For 80 years, the global financial system has relied on the US dollar as the world's reserve currency. But this dominance is eroding as major economies increasingly trade in their own currencies. China, Russia, India, and even major oil producers like Saudi Arabia are shifting away from the dollar. Any significant weakening of the dollar or a sudden alteration in global currency flows could trigger violent swings in currency derivatives. Banks positioned on the wrong side of these trades could take enormous losses. And because currency movements affect nearly every other financial market, The impact would spread instantly across stocks, bonds, commodities, and global trade networks. Perhaps the most disturbing evolution in derivatives since 2008 is their increasing complexity. Banks did not simplify their derivative books. They constructed even more elaborate structures. Derivatives built on derivatives. Optionality layered on top of optionality. You can now buy options on credit default swaps or trade swaps based on indexes made up of other swaps. This creates exponential leverage. A tiny movement in the underlying asset can cause massive disruptions in the value of the entire derivative pyramid on top of it. No risk model can accurately simulate this behavior under extreme stress. Models assume liquidity, normal volatility patterns, and functioning counterparties. But in a crisis, none of those assumptions hold. Markets freeze. Prices gap violently. Counterparties fail. The models all break at the same time. And then there is concentration risk. A structural vulnerability so severe that it defies common sense. In the United States, approximately 90% of all derivative exposure is held by just 4 banks: JP Chase, Citibank, Bank of America, and Goldman Sachs. These are the same institutions that required massive government support in 2008. They are now even larger and far more leveraged. JP Chase alone holds around $54 trillion in notional derivative exposure, according to its most recent filings. The bank's total assets are roughly $3.7 trillion, and its equity capital is around $300 billion. That means JP Morgan's derivative exposure is approximately 180 times larger than the capital buffer meant to absorb losses. The bank insists this is not dangerous because notional value overstates risk and because many of its positions offset each other. But history has shown that offsets fail precisely when they are needed most. JP Morgan insists its net current credit exposure from derivatives is only around $50 billion. A number that sounds comforting until you remember that this is exactly what Lehman Brothers and AIG claimed in the months before they collapsed. Their hedges worked until they did not. When counterparties fail or markets freeze, hedges vanish. And suddenly the gross exposure, not the tidy net number, becomes the only figure that matters. Citibank sits on roughly $48 trillion in notional derivative exposure. It has total assets of about $2.4 trillion and capital of only $200 billion. Bank of America carries approximately $37 trillion in derivatives, backed by $3.1 trillion in assets and $280 billion in capital. Goldman Sachs, smaller in total assets but enormous in derivatives, holds around $47 trillion in exposure, supported by $1.6 trillion in assets and $120 billion in capital. Combined, these 4 institutions hold roughly $80 trillion in derivative exposure, almost twice the size of the entire global economy. In a world where a single mistake can create losses that exceed a bank's capital many times over, insolvency is not an outlier. It is the mathematical outcome of a misstep. The defense is always the same. These are sophisticated institutions with elite risk management systems, armies of quants, and regulatory oversight. But sophistication can be dangerous. Complex risk models do not always reduce risk. Often they hide it, giving banks a false sense of invincibility and encouraging them to build positions. No simpler model would ever justify. Long-term capital management proved this in 1998. With 2 Nobel laureates and the most advanced models in finance, it still lost $4.6 billion in 4 months and required a Federal Reserve engineered $3.6 billion bailout because its collapse threatened the entire global financial system. LTCM's derivative exposure was $1.25 trillion, a fraction of what today's major banks hold. And the deeper issue is the web of interdependence between these institutions. JP Morgan may hedge interest rate exposure through swaps with Citibank. Citibank might hedge with Bank of America. Bank of America could hedge with Goldman. Goldman might circle back and hedge with JP Morgan. What appears diversified on paper is actually a tightly wound loop of circular dependencies. If one falls, they all absorb the shock. This was the dynamic that turned Lehman's collapse into a global crisis in 2008. Every major institution was tied to every other one through derivatives. Post-crisis reforms attempted to fix this with central clearing, where a clearinghouse stands between both sides of a derivative trade. But most of the $600 trillion derivatives market still consists of over-the-counter bilateral contracts with no clearinghouse in the middle. The same counterparty risk that fueled the 2008 meltdown still exists, just buried deeper under layers of complexity and opacity. And now the triggers for the next derivatives crisis are beginning to appear. Several of them are already active, and more will likely ignite in the next 12 to 18 months. The most obvious is interest rate volatility. Over $500 trillion in derivatives are tied to interest rates, and we are living through the most violent rate swings in 40 years. From 2008 to 2021, rates hovered near zero, giving banks a stable environment to expand positions without fear of sudden shocks. But when the Federal Reserve raised rates from 0% to over 5% between 2022 and 2023, stress hit instantly. The failures of Silicon Valley Bank, Signature, and First Republic were the surface-level symptoms. The deeper pain sits in derivative books. Banks do not have to market under current accounting rules. The problem worsens if the Fed has to choose between inflation and recession. If rates stay high, institutions with long-duration assets bleed. If rates are slashed in response to a downturn, the losses flip to the other side of the market. And if the Fed zigzags tightening, then easing the volatility alone could exceed the assumptions built into banks' risk models, triggering margin calls, liquidity shortages, and forced liquidations. The second major trigger is commercial real estate defaults. Over $2 trillion in commercial mortgages must be refinanced in the next 2 years at triple their original interest rates. Many properties simply cannot generate enough cash flow to service the new debt, meaning defaults will spike. Those defaults trigger payouts on credit derivatives like credit default swaps, written on commercial mortgage-backed securities. With the CMB's market around $600 billion, a wave of defaults could produce tens of billions in derivative losses. Not enough to collapse the global system on their own, but enough to weaken regional banks and start a cascading failure. Third, Europe is already showing stress fractures. Credit Suisse collapsed in 2023 and was forcibly merged into UBS. Deutsche Bank, holder of over $40 trillion in derivatives, saw its credit default swap spike during the same panic. A major European bank failure would ripple instantly into American institutions because derivative exposure does not respect borders. A shock in Frankfurt hits balance sheets in New York within seconds. The fourth and perhaps most dangerous trigger is sovereign debt instability. Japan's debt exceeds 260% of GDP, the highest of any developed nation. It has kept rates near zero for decades, but with rising inflation and global rate pressure, that posture is becoming untenable. If Japan must raise rates, or if investors begin doubting the value of Japanese bonds, the yen could plunge, and Japanese government bonds could face default pressure. Given the massive global derivative exposure to JGBs, a crisis in Japan would trigger losses everywhere simultaneously. China faces its own internal storm. Local government debt exceeds $13 trillion, much of it hidden off balance sheet. The real estate sector, nearly a third of China's economy, is collapsing. Giants like Evergrande and Country Garden have defaulted on hundreds of billions as losses propagate through the Chinese financial system. Institutions that sold credit protection on Chinese debt will be forced to pay out, and Western banks are exposed through derivatives, meaning a Chinese financial crisis would not stay in China. Together, these triggers form a fragile constellation around an enormous, opaque, interconnected derivatives market. It does not take all of them to ignite the next crisis. Just one spark in the wrong place. Now here's what you need to understand. When the derivatives market fails this time, there is no bailout large enough to stop the cascade. In 2008, governments and central banks deployed roughly $29 trillion in rescue measures, about 40% of global GDP at the time. It required global coordination, synchronized money printing, unprecedented emergency powers, and political compromises that would have been unimaginable just a few years earlier. And even with all of that, it barely worked. The aftershocks lasted more than a decade. Weak growth, exploding public debt, and political upheavals that rewired entire societies. The derivatives market today is not 60 trillion. Like in 2008, it is 600 trillion. If even 10 fails, that is a $60 trillion hole. That number is larger than twice the cost of the 2008 rescue, and more than half the entire world economy. No government can absorb that. They are already drowning in debt accumulated from COVID spending, past bailouts, aging populations, and slowing growth. The United States now carries over $1 trillion in federal debt. Europe is heavily leveraged. Japan sits at 260% of GDP, a level traditionally associated with sovereign distress. China claims manageable debt levels, but hides trillions in off-balance sheet liabilities. None of them can borrow another 10 or 20 trillion without imploding their bond markets. Central banks could try to print the money, but printing comes with a cost. The Federal Reserve's balance sheet grew from $100 billion before 2008 to $9 trillion after the pandemic, and that expansion helped ignite the inflation spike of 2023, the most severe in 40 years. Printing another 20 trillion would not cause ordinary inflation. It would cause a currency crisis. The dollar would plunge, imports would become unaffordable, wages would collapse, and the political stability of the United States would fracture. Every advanced economy would face the same dynamic. Money printing might save the financial system on paper, but it would destroy the currency that supports the real economy. And a currency crisis is always worse than a financial crisis because it affects every person, not just investors. The political will to bail out banks again has also evaporated. In 2008, the public was shocked into submission. They accepted the idea that saving Wall Street was necessary to save Main Street. But the last 15 years proved otherwise. Wages stagnated. Housing became unaffordable. Wealth inequality exploded. People watched bankers get richer while ordinary families struggled. Today, trust in institutions is low, polarization is high, and populist movements on both sides demand that elites pay for their own mistakes. A 2008-style bailout is no longer politically viable. Any government that tries will face public fury strong enough to become ungovernable. The doctrine of too big to fail has quietly become too big to save. The banks are bigger, more leveraged, more interconnected, and sitting on derivative books 10 times larger than before. Their balance sheets are labyrinths of obscure exposures. Their global footprint means a failure in one country spreads instantly across continents. Meanwhile, the tools needed to rescue them, government borrowing capacity, central bank credibility, political cooperation, have all deteriorated since 2008. There is also a mathematical problem with bailing out derivatives that did not exist with mortgages or corporate loans. Mortgages are assets. Even bad ones retain some value. A government can buy them at a loss, wait, and recover part of the value later. Derivatives are not assets. They are contracts. When one side loses, the other side wins. Bailing out a losing derivative position is simply transferring public money to the counterparty on the winning side, creating no economic value at all. It is pure, unfiltered speculation subsidized by taxpayers. No democratic government can justify that. And even if they wanted to, the system is too complex to match. When Lehman collapsed, it took months to unwind the derivative exposures and determine who owed what. In a crisis where multiple major institutions fail simultaneously, the unwinding process would take years. By the time anyone could even calculate the true losses, the real economy would already be in a depression. So here we are, sitting on top of a $600 trillion derivatives market 10 times larger than the one that nearly ended the global financial system in 2008. Concentrated in a handful of institutions whose failure would terminate the modern banking structure. Multiple triggers are already flashing red, and all of them are likely to activate within the next 12 to 18 months. And unlike 2008, there is no credible mechanism to stop the collapse once it begins. Warren Buffett called derivatives financial weapons of mass destruction. 2 decades later, the world has not disarmed those weapons. It has built bigger ones. The spark could come from interest rate volatility, as central banks flip-flop between fighting inflation and preventing recession. It could come from commercial real estate defaults, triggering waves of credit derivative payouts. It could start in Europe, where fragile banks remain deeply exposed, or in Japan, where sovereign debt has reached historic levels, or in China, where the real estate collapse is already destabilizing the financial system. But the specific trigger does not matter anymore. The system is now so interconnected and so fragile that any shock of sufficient magnitude will detonate the entire structure. When one major bank fails to meet its derivative obligations, counterparties will discover their hedges do not work. Margin calls will explode across the system. Clearinghouses will face losses that threaten their solvency. Within hours, every major global bank will confront losses they cannot absorb. Governments will declare emergencies. Central banks will create new lending facilities. Politicians will stand on camera, promising that everything is under control. But none of it will work, because the problem simply exceeds the capacity of governments and central banks combined. You cannot bail out losses greater than half of global GDP. You cannot print enough money without destroying the currency. You cannot legislate away insolvency when the liabilities are larger than the world's productive capacity. The mathematics does not allow a rescue. What happens after the derivatives market detonates is unknowable. Not because the future is mysterious, but because we have no historical reference for a crisis on this scale. The Great Depression unfolded over years. A derivatives collapse would unfold over days or weeks. Bank accounts would freeze. Credit cards would stop working. Pension funds would implode. Supply chains would fracture. Unemployment would surge to levels unseen in nearly a century. Social and political stability would unravel. This is not doom for the sake of doom. It is pattern recognition and basic arithmetic. A $60 trillion system nearly destroyed the world in 2008. Today, that system is $600 trillion, and the capacity to save it is gone. The triggers are appearing now. The cascade is inevitable. The only unknowns are timing and magnitude, and the answer is likely sooner and larger than anyone expects. Because every financial weapon of mass destruction ever created eventually gets used. Derivatives are no different. $600 trillion in leveraged bets built on the assumption that counterparties always pay. When that assumption fails, everything fails. And there is no amount of money in existence that can put it back together again.